Good morning. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and I want to thank you for joining us for our webinar this morning, Up, Down, or Sideways, Where Are Indiana Farmland Values Headed? Joining me today are my colleagues, Dr. Craig Dobbins, who's a professor and extension economist in the Department of Agricultural Economics, and Michael Langemeier, who's our Associate Director of the Center for Commercial Agriculture and also a professor of Ag Economics as well. If you haven't joined us before, I wanted to let you know that if you have some questions during the course of the webinar, you can simply pose those by emailing them to me at my email address here at Purdue, which is on your screen. And I'll be monitoring that during the course of the webinar. And of course, if we don't have a chance to respond to your question during the webinar itself, we'll respond later today by way of email. But don't hesitate to send us an email if you have a question or need a clarification. So Craig, I want to talk a little bit about this, the Farmland Value Survey that you've been conducting for many years now. You might give us just a little bit of background, a little history about the Farmland Value Survey before we start talking about some of the results.
Okay. Well, this is a survey that began sometime in the early 70s, and it was an effort to collect some information about what was happening to farmland values at that time. There was quite a boom in the early 70s or the 70s, and so that's how it kind of got started. And it's been going on ever since. And so basically what we do in the survey is that we send it to people that are involved in the farm real estate business as a part of their professional life. And so these would be rural appraisers, professional farm managers, ag lenders, which would include banks, the Farm Credit Service Organization, and also the lending part of the FSA office. And we send them a questionnaire, and we ask them to tell us what their view of the value of farmland is in June when we do this. We also ask them to look back to December and then to put on their forecasting hat and look forward to the next December. So it's a combination of history, current, and future here. And so, and as I said, we've been doing this for almost 45 years now.
So a mid-year survey, a little bit of history, looking backwards, a little bit looking forward.
Yep.
Maybe share some of the details with us here.
Okay. Well, I guess I should say that in addition to asking about farmland values, we ask people about cash rents as well. And what we're doing with those set of questions is asking them for kind of what the current cash rent is today. So, what's the rent in June that was negotiated last fall, sort of thing. And we ask people about different qualities of land, and we're not real precise about what we mean by quality. And so in order to get a bit of a handle on that, we ask people to give us an estimate of what the long-term corn yield would be. And so we use that long-term corn yield as a gauge of productivity for the soil. And so we got three categories, really: top, average, and poor.
And so you use those corn yields to sort them?
Yes, yeah. And so we generate an average then for the whole state, areas of the state, and by land qualities in each of those areas of being top, average, and poor.
Okay, great. Let's talk about some results.
Okay, well, not too surprising, I guess, is that farmland values in Indiana are starting a decline, at least as we compared 2014 with 2015. And so here's the chart that kind of makes that comparison. Statewide, we've got a decline of 3 to 5% if we kind of round things off. And so it's not too surprising. I think after we have had this long period of increasing values, that we kind of find now that the economics of crop production have changed and margins have flipped from being very positive to being almost as negative as they were positive a little while ago. That farmland values are making a bit of an adjustment downward now, it seems.
So backing up a year, if we thought back to the 2014 survey, the results this year are different than what we saw a year ago, correct?
Yeah, they are. I mean, this is, we had a, if you want to look at this, last year was the peak, okay? And so we've come down. Now the question is this the start of a new trend, or is this a momentary blip in this trend that will turn back around and go up? And you know, we can have some discussions about what the future holds in a little bit here. So.
Okay, all right. So let's take a look at maybe a little longer term.
Yeah, so putting this into context of what has happened in the past, we've got here a chart that shows what economists call the nominal value, or the value at that point in time, and then we adjust for inflation, and that's the top line. And you know, this goes back to our starting point in the 1970s up to 2015 here. And you know, the bump in the late 70s, early 80s is the point in time that everybody still kind of talks about, and everybody was concerned about in this run-up that we had this time around. You know, are we going to repeat the 70s and the 80s? And so, you know, it's that run-up and run down the other side of the hill still shows up fairly strongly, especially in the real terms or inflation adjusted terms here. So we've had a long run of things going up with a few points in time when we had a bit of an adjustment. You know, the most recent was kind of in the 2008-9 period of time when crop prices were coming down from what we thought were highs at that time. And costs were going up significantly at that time, and so the margins really got squeezed in 2008, 9, and 10. You know, had some yield problems, and so supplies tightened up, prices took off again, and then, you know, land values followed the prices back up again. So we've now reached a point where supply in the grains market seems to have caught up with demand. Prices are coming down again, and so we've got tighter margins again. And that's having an influence on farmland values at this point.
So the real question, we're going to try and address this as we move through the rest of the webinar, but I think the question for a lot of people is going to be, is what we're seeing right now a repeat of what we saw in that perhaps 2009, 2010 time frame, or is it going to turn into something that resembles in some sense what we saw in that roughly 1979, 1980 to about 1986 time frame?
Yeah, I think that's the question that everybody would like the answer to.
Yeah, including us,
and you've
right?
got the answer, right?
Including us, right? We would like
Yes,
that
that's
answer
right.
as well. All right, so we'll see if we can maybe shed some light on that as we head through here. So let's talk about it on a regional basis.
So on a regional basis, you know, the picture's a little bit different. You know, if one looks at the west central and central part of the state, this is the area of the state where farmland values have historically been the highest. West central region has been generally the highest place. Central is kind of second. And in those regions, we've seen over this last year, you know, what I would call a significant downward movement in farmland values. You know, anytime you start getting to the double-digit range, that's getting to be noticeable in this sort of a market. And so the areas where they went up the most are the areas that seem to be most impacted in terms of coming down as well. The northern part of Indiana, you know, again, consistently downward, but not nearly as sharply. We get to the southern part of the state, and we get surprised by the southwest, which is going upwards fairly strongly yet. And so I think this is a little catching up, and the fact that there were some pretty good crops in the southern part of the state. And I see that our graphic got a little messed up here, that the numbers for the southeast have disappeared.
Yeah, a little bit.
But
our slide editor apparently had a problem.
Yeah,
that would be me, right?
It was just fine a little while ago. But anyway, you know, for the southeast, it's basically flat here. Okay.
Let's look at cash rents, because I know that's on a lot of people's minds, and we've had a lot of discussions in some previous webinars about cash rents. Let's talk about what the survey
Yeah, and I
revealed.
suspect there'll be some more discussions about cash rents this fall. Cash rents, again, we've kind of appeared to have turned a corner, and we're headed downward, not as much downward as farmland values have adjusted, which is a fairly typical sort of reaction in markets. Generally, what we find when things are going up, farmland values go up faster than cash rents. We turn the corner, and when they start to come down, land values come down faster than cash rents as well. But it would appear that we are beginning to make some adjustments in the cash rental market in terms of things headed down. How this is going to unfold into the future, again, it's going to depend a lot on what happens to commodity prices. Right now, people aren't real positive about there going to be increases in corn and soybean prices. So I think certainly for next year, there's going to be some more serious conversations about how to adjust cash rents, because the margins are really, really tight at this point.
So I think one thing that we've talked about in the past, Michael, has been the fact that the averages on the survey are not matching up per se with some of the auction values that we hear about with cash rental rates. Have you picked anything up with respect to some of the really high cash rental rates that we've heard about over the last several years?
Yes, there's as Craig indicated, there's a lot of variability in cash rents, and so we see an average here of approximately $230. That's going to be $50 lower to $100 lower, all the way to $50 to $100 to $150 higher, and so there's a lot of variability in cash rents. My anecdotal evidence would be that the higher cash rents are probably coming down a little harder than these averages, but we don't have a lot of firm survey results related to that.
Yeah. So we've heard some really peak values the last several years, $350, $375, even $400, in a few cases even over $400. And I guess all of us have picked up maybe at various points in time that there's been much less interest in those really high cash rental rates, especially over the last 12 months.
Yeah, I think that's right, that the margins in crop production aren't there to support the really high cash rents any longer. And so tenants have gotten a bit more cautious about being really aggressive in these auctions. And so I think, this is just a common phenomenon is, the cure to high prices is high prices. Well, okay, we've kind of caught up now, and now we're going to have to find a new equilibrium point if there is such a thing. Given the current situation in the crop sector, we're going to have to find a way to get our costs down.
Yeah.
Not just cash rent, but other costs as well.
Right. So as we look at this fall, for example, if we see some more cash rent auctions, we would not expect to see some of those peak values that we saw. And some of those really continued last winter. We still heard some stories last winter about some very strong cash rental rates at some of these auctions.
Yes, I would find that we're not going to see the peaks as high as they have been. Like Craig said, the margins just aren't there, even on this higher quality ground to support some of those higher rents.
Okay.
And one's got to remember that it's the high numbers that always get the story written about them.
Yes.
There are lots and lots of numbers that are much lower than the high number, but you don't hear much about them. So.
And I think that's a good point to make, Craig, and the fact that the average values that you're capturing in the survey probably are much more representative of what's really taken place out there with the bulk of farmland, as opposed to the relatively low percentage of farmland we hear about that's rented at the occasional auction that has been at some of these really high values.
I think that's right. It's really kind of interesting, kind of the psychology of the market and our role in trying to provide information about, where the market's at. Prior to the 2006-07, when grain prices started going up, there were numerous comments about the fact that our survey had values that were way too high in the rental market, that there was no way that people could pay that sort of price. things on that front have been pretty quiet over the last 10 years. And I think in many cases the numbers that we may have been reporting were smaller than the sorts of numbers that were showing up in the press, so there wasn't as much concern. But I'm getting ready to get my flak jacket back out again and try and deflect some of this, your numbers are too high again sort of thing that I suspect is going to be coming.
Yeah, good point. Well, you've got a chart here that shows some history with respect to these cash rental values, and that's a pretty interesting chart. I look at especially those values, the inflation-adjusted values back in the late 70s, and I have to admit, I was a little bit surprised they were that high when we adjusted for inflation.
Yeah, I mean, if one wants to think about the golden era of agriculture, from a landowner perspective, it was back in the late 70s. We haven't gotten close to the peak we hit back then. And the other thing that I find interesting about this chart is that it really does have a different pattern to it than the farmland values chart. I mean, in the farmland values chart, 70s went up, 80s came down, and then we began this slow progression back up again, and then things kind of took off. That's not in the cash rent chart. Things went up, things came down, and then we just kind of flattened out for 20 years or so, and in real terms. And then it's only been in the last few years that we've had a little pickup in the real values of cash rent here.
Let's take a look at the regional variation.
And again, regional variations, for the most part, well, they're a little more mixed than they were for land values. But again, West Central and Central region, it's pretty clear that rents are coming down a bit. Again, if you look at those two regions together, somewhere between a 3 and 5% reduction in cash rents over last year. The northern part of the state, well, you could say they're flat to down slightly, I think. The southern part of the state, well, they're flat to up. And we've kind of flipped regions where the strength on the cash rent side seems to be in the southeast rather than the southwest. But a little bit different in the southern part of the state than in the northern 2/3. So again, all of these numbers, as Michael said, there's a big variation in these things. And so one needs to be conscious of that. And so when you talk about averages and when you use these numbers, they're not terribly useful for figuring out what your farm ought to rent for or what the value of your farm might be. But they give you a general sense of the direction and the magnitude of changes that are taking place in the market.
So Michael, we were talking a little earlier about what was going on with those two southern regions, and maybe you could shed a little light on what we think was going on with respect to the difference between the South versus, for example, West Central.
I think there's two factors going on there in the South, both Southwest and Southeast here. One of them is I don't think cash rents nor land values went up quite as fast in the southern part of the state as they did in particular in the central part of the state. And so I think maybe it's catch up a little bit. But I also think that the very, very strong corn and soybean yields compared to trend yields in the southern third of the state is contributing to these high cash rents and high land values in the southern third.
Yeah, so we had pretty strong yields in most of Indiana last year.
But they were very strong in the southern third.
If you compare it to the longer term averages, the difference was even bigger in the South, especially in the
for example,
Southwest.
Posey County, way in the South there, had 200 bushel corn and close to 60 bushel soybeans. That's considerably above trend. For that part of the state. And so I think those very strong yields are contributing to what we're seeing in cash rents and land values.
So we had a stronger revenue situation relative to normal in 14, and that was reflected in those rates perhaps, right?
Sure,
Okay.
Yep.
So let's take a look. You wanted to look a little more detail at West Central Indiana.
Yeah, this is very important to point out. This is West Central Indiana. West Central Indiana tends to have the highest cash rents and highest land values in the state. In fact, cash rents and land values are probably more similar to parts of Illinois. than they are to the rest of Indiana and west central Indiana. So it's important to point that out. These are different numbers than what Craig has been showing in terms of state averages. But the peak was not 2014, just like it was for the state average of Indiana, and it peaked at $291, like is indicated on the chart there. In 2013, it was right around $280. In 2015, it was right around $280. So it came down just a little bit in 2015 compared to 2014. What I've got in red there is my projections, and these projections are based on a historical relationship between net returns and crop rents. Historically, if you look at land values over a long period of time, I typically use 1960 to the current period. If you look at the relationship between net returns to land and cash rent, there's a very strong correlation there. And so that's what I'm using here, is that very strong correlation to project what could happen in the next 3 to 5 years. Here I've just got 3 years presented. But if net returns stay relatively low, like they've been in 14 and 15, and also we're expecting them to stay relatively low in 16, 17, and 18. If that does occur, then we're probably going to see some wind taken out of the cash rent sale here, coming down from that peak in 2018. I've got a value there of $237. Now that might seem like a big decline, but you got to keep in mind here that cash rents doubled in the last 10 years in west central Indiana. Going from 237 from 291 is only about 15%. And so we're still coming down that hard compared to how fast we went up in the last 10 years.
So to me, a couple of points there, Michael. One is the idea that, first of all, based on a long-term history, what takes place with respect to the underlying economics of the industry do in fact drive these cash rental rates. A lot of times we hear people talk about a little bit of a disconnect there. And in the short run, there can be a little disconnect, but from a longer term standpoint, if these returns in the crop sector and the corn and soybean sector continue to be low or lower than they have been in the recent past, it will ultimately drive both land values and cash rental rates, right? That's
yes.
one of the big picture
yes.
here. And then the second one is that speed of decline tends to be slow, especially in the early stages, right? As we really, I would argue perhaps it's a little bit about convincing people that returns are going to stay at a lower level for an extended period of time, because we don't tend to adjust these average cash rental values that rapidly, right?
That's absolutely right. I mean, it's all, the future is always uncertain, okay? And you never know for sure what prices are going to be, what your costs are going to be. And so, I guess in kind of a crude way, we're kind of guessing at what our returns are going to be, and we hope it works out, and usually it does. But it's these things are just slow to adjust in that regard, and
certainly there's let me answer both of those questions, Jim. Yes, there's a very close relationship between net returns and cash rent, but that's for a long period of time. And you're right, net returns adjust much, much faster than cash rents. Cash rents are pretty, if a 5% is a big drop in cash rents, or 5% increase is a big increase in cash rents, whereas returns can drop $100, $150 from one year to the next. And so cash rents are much slower to adjust to net returns. And as you indicated, it usually takes several years of relatively low net returns for cash rents to trend downward for more than 1 year.
And thinking about your chart,
and that's what's happening here is I'm projecting net returns to be relatively low for the next 3 to 5 years. If that does take place, we fully expect cash rents to decline.
And thinking about your projections, Michael, if you look at 2018 and maybe a couple of years you don't have on the chart, maybe out to 2019, 2020, it's going to be in that time frame, if returns stay where they are now, when we would expect to get these cash rents back to what we would call perhaps more of an equilibrium level.
You probably have to go a couple more years here. If you look at the 2015 to 16 and then 16 to 17 and 17 and 18, it's dropping about 5% per year. I would think another 5% going to 19, another 5% going to 20 before we reach an equilibrium.
Yeah, okay. Craig, let's talk about what the respondents had to say with respect to a forecast.
Yeah, so we asked people to look forward, okay, and that's kind of what this chart is about here. So we've got 2 periods of time, one December 14 to June, and then June to December 15. And I guess one could say we're consistent pretty much here in this chart. We've had declines the first half of the year. People are expecting declines the last half of the year. And not only that, with the exception of the poor land category here, declines at about the same rate. That, we're in the 4% range for top and average land, a little lower for poor land. So I think, short term, this confirms Michael's hypothesis that rents are likely to come down. People, our survey respondents agree that rents are likely to come down more. And so as we've talked about, there's this link between income and value in the farmland market. And so from an economics perspective, we like models, and we like simple models. And so this is a simple model of how we get from income to value in the farmland market. Okay, we take the net return that we get from land, and generally we use rents as a proxy for that return. And then we divide that by the difference between the discount rate and the growth rate in those returns. And if you do that simple arithmetic, you translate this annual income into value. So that gives us a framework to think about this. And I think that takes us to the next slide where we've got, so here's our value to income multiplier. And what this line that wiggles around the chart is about is that it shows you how much people are willing to spend for $1 of annual income. Okay, so if we go back to the peak that we hit in about 1979, when the first big run-up in land values was coming, people were willing to spend 21 times current income for an acre of farmland. Okay, now that's changed. In 2015, we're at 34. So people are willing today to spend 34 times annual income versus 79 when they were only willing to spend 20 times annual income. And one of the little mysteries in this market is what's changed here. Why are people so willing to spend so much more for an acre of farmland today relative to current earnings than they were years ago? Okay.
So Michael, we talked about that earlier, and we threw out a couple of reasons why, and one of them you mentioned in specifics.
Yeah, we were discussing this over coffee before the webinar, and one of the big reasons I think is low interest rates. I think a lot of people have factored in the fact that the interest rates have been fairly low for several years now, and that's caused them to bid up land a little higher than they would otherwise. I think the other one is just pure optimism. We saw a long stretch of time where net returns to crops, corn and soybeans specifically, were very high, and people just build up optimism.
So you think about Craig's equation, that brings us back to that growth rate. People were very optimistic that growth rate was going to not only remain positive, but very positive.
Yeah, and
for an
the growth rate was
extended period of time.
double digits for several years in a row there. I don't think people were expecting the double digits to last for 30 plus years, but they were expecting it to be relatively large compared to the historical average. And so I think optimism along with these low interest rates is really huge factors related to this land value to income multiplier breaking through 30.
So the last couple of years, Craig, we've been record levels on the multiplier. But 15 was down just a fraction compared to 14, right?
Right, yep.
And so our challenge is that the start of a trend, or is that a bit of a blip, right?
Yeah, that's it. And you've got the answer, right?
You're the expert. You've been doing this for, what, 30 years? You're the expert.
Yeah, well, okay. So let's talk about these two, well, let's see. So let's look at the mean there, 20, okay? Now, that there's this notion in statistics that, in theory as well, that you've got variation around this average. Everybody knows that, okay? And things go up and things go down. And if we get really high, we're going to eventually revert back to the mean. but if you look at this chart, this multiplier doesn't seem to act that way very much, at least. It just kind of picks a direction and then goes. And I think, why is that occurring? And part of it, I think Michael has addressed. It's optimism. The other part is interest rates. We, over this period from the 80s to now, has been a period of time when interest rates have been going generally in one direction, and that's down. Okay, and if you look at the little formula that we had, lower interest rates mean people are going to pay more and more for farmland, and that's basically what's happened. They're willing to spend a lot more because of these lower interest rates. So I think that's a very important point here. Now, we've been hearing about the Fed wants to raise interest rates and that sort of stuff. What's going to happen to this multiplier if that really does begin to happen? I mean, we've had this out there for a long, long time, that interest rates were going to go up, and they still haven't. Okay, someday they probably will. Okay, the question is figuring out what day that is. But if we enter a period of time when interest rates begin to rise, and if margins stay tight, that's going to put additional pressure on land values coming down here.
So to back up a little bit, we're looking at the chart, looking at the blue line. We've seen that multiplier increasing pretty darn consistently since the mid-1980s.
Yep.
Up through last year, and to some extent maybe flattening out this year. Over that roughly 3-decade span, we've seen interest rates decline, right? So one of the big supporters of that multiplier really has been this very long-term change in interest rates.
Yes.
And we've all been a little bit, anxious with respect to the idea that the Fed might start increasing rates. I think a number of us have been talking about locking in rates for at least a couple of years or longer. Right. Whether or not that happens, I think the odds of continued declines in interest rates from current levels are virtually nil, right? So we're probably not going to get any additional support out of the interest rate component of your equation, and likely to get some reduction in the multiple coming out of increases in rates, whether they happen this year, next year, or perhaps a couple of years in the future, right? So
I think that's right. Yeah, and so these other two horizontal lines in the picture here talks about a plus or minus 2 standard deviations. Well, okay, you got to go back and remember a little of your statistics here. And so what that says is that we ought to find the values of this multiplier within that range 99% of the time. So the fact that we're above the line of plus 2 standard deviations, the probability of being up there is fairly small, and staying up there is fairly small. So at some point, this thing probably is going to move back down a bit.
Okay. Now we're going to look at this in a little different way. Michael, you want to talk a little bit about that, or do you got something before we move into that?
Yeah, I get pretty excited about this chart, Jim. Jim and Craig both know that. And a couple things here. I think there's going to be quite a bit of downward pressure, on this multiplier, because I think interest rates they'll be flat, but probably increase in the future. But also, I think the optimism is going to deflate here a bit, and so I think we're going to come down here, and we could come down pretty hard.
Yeah.
Perhaps not as much as the 80s. I'm not expecting that big a decline, but I think we're going to see a decline in this land value to income multiplier in the near future. But another point I wanted to make is we've taken this chart back to the 1930. We're at a very high period right now, even compared to that very long period. There was no period from 1930 to 1975, which is not on this chart, that was even close to 33.5. And so we're in very unprecedented territory right now with the land value to multiplier above 30.
Okay. So that takes us to our next slide, and you've done some work based on something that Professor Schiller at Yale University has done relative to the stock market, and more recently to the real estate market, looking at the urban real estate market. And you've applied that to the farmland market, so I'll let you talk a little bit about that.
What Schiller argues, and I think he's right, is rather than just using 1 year of earnings, net income from land from 1 year or cash rent from 1 year, why not use a moving average of earnings? That way you're smoothing out a little bit of the economic cycle in terms of stocks. But for agriculture, we know net income varies quite a bit from one year to the next. And so that's the whole idea here, is rather than just using 1 year of earnings, let's use 5 years, 10 years, 20 years of earnings to look at this price earnings ratio for stocks and price rent ratio for farmland. So that's essentially what we've been doing.
So your price rent ratio is really another term for the multiple that Craig was referencing to, right? So same idea, but you've done this cyclical adjustment. So let's look at the chart.
And what we typically do is we look at least three different ratios here. Price to current rent, that's similar to what Craig was talking about. Land value to income multiplier, and then we look at price to 5-year average rent. So we, a price in relationship to what the previous 5 years of rent has looked like, and then price to 10-year average rent. And again, it just takes out that variation from year to year, and takes out business cycle and some of these kinds of things. And so that's what we've done with this chart. You'll notice that these three ratios tend to track one another quite well. However, there is periods where they do diverge. One of those periods was approximately from 1975 to 1980, where the 5-year and the 10-year was increasing faster than the price to current ratio. Also, in the mid-1980s, they were decreasing faster than the price to current ratio. And then the most recent period, we'll see quite a bit of divergence between the 5-year and the 10-year average rent price to rent relationships. And so there's at least three different periods in this graph where we're seeing some divergence. So let's talk about those in turn. Let's talk about the 1975 to 1980 and the current period. What was going on there? Well, part of what was going on there, I think, is that land values were increasing faster than rent. And so you're seeing, using these longer-term average rent relationships, you're seeing a bigger spike in the price to rent ratio because of that. Rents were not keeping up with the price of land. So you're seeing the spikes there in the recent period, and the same was true in 1975 to 1980. Conversely, if you look at the mid-1980s, the opposite was occurring. We were adjusting land values faster than we were adjusting cash rents, and so you saw a divergence on the downside with respect to these three ratios. And so it's just a little different look at the same thing.
So we see some signals on those charts, right? When the red lines start crossing above and below, right? So if you're a technician, you start to get some signals here, and we saw it back in the early 80s when the red line was dropping pretty hard.
Yeah.
And that was an indication of what was taking place or going to take place. As we see this red line drop this time, it's looking like we could be getting ready for a potential sell signal, so to speak.
Yes, you'll see that red line and that green line have dropped very, very strongly in the last couple years, and I think that's a signal that land values are probably going to decline faster than cash rents, and that's what we saw with the survey this year. I think land value declines were double if you look at the state average, and it was also a little higher in West Central, which is what I'm using right here. And so we've certainly seen that signal. Land values coming down harder than cash rents. And that certainly will take down all of the P ratios, but particularly these longer term ones.
Yeah, so it could be a little bit of a leading indicator, and of course I think that's what Schiller would argue as well.
Now, we should mention here, I mean, we've talked a little bit about it earlier, but I'm a bit of a bear when it comes to cash rents and land values, but I don't see us repeating what happened in the 1980s, things crashing that hard. I see a correction, but it's going to be more of a soft landing compared to the crash we saw in the 1980s. And so I think we're going to continue to see some correction in these price to rent ratios in the next 2 to 3 years, but they're not going to crash like they did from 1975 to 1985. At least we don't expect them to.
Okay. Craig?
Yeah, so this chart here, I guess is an effort to look at other influences in this market. Income isn't the only thing that drives farmland values. And so this was an effort to try to say, okay, what else might be out there that might be influencing this? And so, and Michael talked about the enthusiasm or the optimism that was in the market when prices were high. And this gets at a bit of a measure of that sort of thing. So the first three little sets of bars there look at the net income from crop production, the growth rate that's going on in that net income return, and then what crop prices and the outlook for prices are. And this is for the last, well, this is 2013, 14, and 15. And you can see how the market has changed in terms of the respondents thinking about what the influence was of these things. And we've gone from a pretty positive view of the world to a fairly pessimistic view of the world about what's happening on the income side. So I guess it just kind of confirms that, yep, that's what this market is thinking at this point. Then we've got other things that are still pretty much all positive, but much smaller than they used to be. So interest rates are still a positive influence in this market. They're low, okay? That helps values in the market. Certainly, inflation is still a positive influence in this market. The supply of land that's on the market, isn't excessive, which was one of the things that caused the rapid decline in the 80s, was that we were trying to get a lot of land was brought to the market for sale in a short period of time, and the only way to get it to clear was to lower the price. And so as long as we can keep a pretty good balance between supply and demand in this market, that's going to help hold prices up. And the other thing that is had a bit of a decline but still positive is the cash position of buyers. One used to hear a lot about the strong cash position that these buyers were in, and that they were oftentimes making big cash payments when making these purchases. Well, the tighter margins have reduced that cushion of cash, and so it's less positive than it once was, but still positive here. And I guess I'm a bit intrigued by the last category of agricultural policy. There have been a number of studies done by economists and others trying to explain how policy has been a supporter of agricultural land values and those sorts of things. Respondents to the survey have decided that ag policy is no longer relevant to what the price of land is, that we really have got the government out of agriculture in this context. Now, whether they're right or not remains to be seen, but it's not a big factor at this point.
Looking ahead to 16, Jim, the couple of them that really, I think, deserve a little bit more explanation here as we look forward, and that's the alternative investment in the cash. The alternative investment really dropped, as Craig indicated, from 2013 to 2015. I think that's probably going to continue to drop. One of the things you heard quite a bit when you talked to people that were buying land is, where else am I going to put my money? The interest rate's really low on savings and CDs, and the stock market wasn't doing real well for a period of time after the financial crisis, and so it was a good place to put money. We're probably going to see a deterioration in that bar as we move forward the next year, and then in particular, this cash. As Craig said, that bar did come down quite a bit in 2015. I think that bar is going to come down even further as people get tighter working capital situation. They're not going to want to part necessarily with their working capital by buying land or buying machinery.
That would certainly be true if they listen to our webinars, right?
Yeah. We had to get that in again.
There is one positive that neither one of you mentioned, but I think it's important, particularly as you look at some regional variation in prices, and that's the impact of livestock income.
Yeah.
As you look at it, not only within the state of Indiana, but actually you look at a little broader context, you look at some other states and portions of other states, and I'm thinking about Wisconsin, we mentioned earlier before the webinar got started. We've seen some of this strength show up in some locations in Iowa, been pretty widely reported. So livestock income has been a supporter of land values, particularly in locations, obviously, where livestock production is very important. And but that's very regional. And so it depends very much on your location. But in some places, that's had a big impact.
Yeah, so that's probably the one thing in this chart that has really changed in the other direction. Yeah. Everything related to crop production has shifted from positive to negative. Well, livestock is just the reverse of that. We've shifted from negative to positive influences in the market at this point. So yeah, I think that's right. It's now a supporter.
Okay.
And we've been focusing on non-irrigated land in this webinar discussion, pasture rent is still remains very, very steady, if not increasing, in a lot of places, and so we're not seeing the same trend in pasture rent throughout the Corn Belt and also west of the Corn Belt.
Yeah, good point. Okay, let's talk about this, the forecast
Yeah,
here.
so everybody wants to know what's going to happen. Okay, so this is mainly an effort to, since I don't know, to pool everybody's view of the future together here. And so one of the questions we ask people is what's going to happen to farmland values over the next 5 years? If you look at today and then 5 years ahead, where are we going to be at? And you know, are we going to have higher, no change, or a decrease here? Well, we don't have a consensus. Well, we have sort of a consensus, I guess, in that regard. 26% of the respondents said that 5 years from now, land values are going to be higher. So this is a temporary downward correction, and then we're going to go back up a bit. 26% said we're going to be right where we are now over the next 5 years. So, you know, we may go down, but we're going to come back up to where we are. The more pessimistic group, 48%, and this group's gotten bigger over the last couple of years, certainly, said they're going to be lower in 5 years than they are now. So they're in Michael's camp here, that things are going to adjust and they got to adjust downward. Okay, so then we ask people, well, okay, if they're going to adjust up, how much are they going to go up? And that group said on average they're going to be up 9%. And then for those that are going down, they're going to go down 14%. Okay, and again, those numbers are really surprisingly small relative to the sort of movements that the market has historically made over a 5-year period. But I guess they show that in general, there are more people that are pessimistic now. And if you take the group as a whole, they indicate that farmland values are going to be down 5% over the next 5 years. That's pretty modest. Okay.
That's a modest decline, but you know, I think the other thing that's kind of significant is roughly 3/4 of the respondents said farmland prices will be flat to down over the next 5 years.
Yeah, that's a good point. Right.
I think that speaks volumes about where this market is likely to go.
And that number has changed. You know, 2 years ago it was the other way around.
Yeah.
So the outlook in this market has shifted significantly.
Yeah.
Yeah. So this is just a chart that shows what happens to farmland values over a 5-year period. So I was kind of wanting to compare these forecast changes to what actually occurs in the market. And so to read this chart, if we go back to 1967 and you think of buying land in 1967 and then you're going to get rid of it 5 years later, well, it would have been up in value modestly, okay? In the late 70s, we went through a period where land values over a 5-year period increased a lot, okay? We're up above 200% in 5 years, you know, and we get years back to back at that rate, you know. And then the 80s come along and it went down, and then since then we've been up, you know, every 5 years fairly significantly for a long period of time. So these modest adjustments that people say on average are likely to occur are really not supported by what happens in the market here. That the variability, while it may be less than the stock market, Michael, there's still variability in this market, and it's significant.
So to restate that, Craig, people underestimate the variability in farmland values over pretty long periods of time.
That's right, yeah.
So don't take the 5% decline that you had in the previous slide as gospel truth. Based on past history, it would not be surprising if the actual change was significantly larger than that. And Michael, I guess you've been one of the ones that's argued it will be larger than that 5% decline that the average is.
Yeah, rather than 14%, I'm expecting 25%.
Yeah. So, all right, let's take a look at.
So again, we're trying to get a grasp on what these people, how they view the future of agriculture here. So if you could hit your clicker again here a couple of times. Yeah, so we asked them about what you expect the price of corn and beans to average over the next 5 years. So the tall bars are soybean prices, and the smaller bars are corn prices. And so if you look at 2011, 12, and 13, we had a pretty consistent series of 3 years there where people thought that corn prices over 5 years were going to stay in the upper fives dollars a bushel here, okay, and soybeans are going to be around 12. Well, that expectation has gotten modified for the last couple of years. You know, came down a bit in 14, came down again in 15. So now the expectation is over the next 5 years, we may average about $4 a bushel for corn, and we're going to average a little less than $10 for soybeans. Okay, so we're ratcheting down our expectations in this market, which I guess given what's happened to commodity prices, isn't at all surprising here. Okay. Now, interest rates and inflation, what are their view about those things? So if we can get our lines to pop up here. Yeah, so again, interest rates are the top line there. And again, people are expecting things to remain pretty much status quo as they have for the last 3 years. And again, inflation, no big changes expected there in terms of the next 5 years. So again, what the respondents kind of see are tightening margins with stable interest rates.
And you know, Craig, when I look at the corn and soybean forecast that the respondents provided, they were actually pretty close to what some of the major forecasting agencies like the Food and Agricultural Policy Research Institute at the University of Missouri is forecasting. You know, soybean prices a little below $10 and corn prices on the chart you've got $4. I think FAPR is maybe a shade under $4 if I remember right for a 5-year average, but pretty close. The other one that's interesting on there to me is the interest rate forecast. Lots of discussions about interest rates going up. Our respondents seem skeptical of that. And actually, I suppose if you look at what's taking place in the bond market, there seems to be skepticism in the bond market as well with respect to whether or not the Fed really will be successful in raising interest rates here, at least in the near term.
I think that's right. You know, we've heard that interest rates are going to go up for a long, long time now, and they've remained pretty low. Some year that statement's going to be right. The big challenge
that would
is
be the broken clock
figuring out which year this
huh?
is going to be. That's right. Yeah. Don't change your story.
Right. It'll eventually hit, right? Broken clock is right twice a day.
That's right.
All right. Michael, let's talk a little bit about your projections with respect to corn and soybean returns.
We've talked about this previously in the webinar, so we don't need to spend a lot of time on this. But 2007 to 2012, of course, were very, very strong returns. You'd find it difficult. You'd find it difficult to find a period of time since really 1930, if not before, where you saw 5 or 6 years in a row where earnings were really strong. And so this is a very unusual period in agriculture, and I think that led to the optimism that we saw in land values. Obviously, things have changed a lot since 2013, and in particular in 2014, where we're seeing a lot of red ink. Even though I got these green bars here, they're very negative. And with my cash rent projections going down 15% in 2018, we're still only a break even. So that's disconcerting to say the least, that even with that relatively large drop in cash rent, we're still right at about break even.
Yeah, break even, and really it could be a challenge to get to break even based on our previous discussion for a lot of folks. So let's kind of wrap things up a little bit. Oh, Craig?
I was going to say a little bit about that chart. You know, break even isn't all that bad in this chart because this is a full costing of everything. So, you know,
you're getting paid for your capital that you own. You're getting paid for your time in the business. So no, break even's actually not that bad a thing here.
That's right. This is what economists would call equilibrium.
Yes. Okay.
Everything's been paid for. Prices cover all costs, and so we're in good shape here. So this is, you know, so just being at break even isn't as bad in this chart as one might think.
Good point. Good point. All right, let's kind of wrap up with some inferences here, Michael.
Okay, this is one of the reasons why I'm a bear with both cash rents and land values. I think the decline in net return is really driving cash rents downward, and lower cash rents also drives land values down. But land values also have several other factors that are working against them. One of these being this possible increase in long-term interest rates. Again, I sound like a broken record because I've been talking about that for at least 3 to 5 years. And so, but I still think that's going to occur at some point here. Also, increase in inflation would change the interest rates, and so that may occur. And then I think there's going to be an increase in the risk premium for the farming sector. What I mean by that is agriculture is moving into a more uncertain, a more risky period where returns are not as good. And so from a lender perspective, they're going to require a higher markup over prime to lend to agriculture. And so that's what I mean by increase in risk premium for the farming sector. And then going back to the high P rent ratio or the land value to income multiplier, that's very high compared to what we've seen historically. And so I think that's going to put downward pressure on land values.
Okay. Craig, let's kind of summarize some of the findings from the survey.
Okay, so I think the survey is another one of many that have been done here recently that show that farmland values are beginning to come down. Okay, so we're in the 4 to 5% decline range. There are more declines expected the last half of this year by our respondents, and so the people are a bit more pessimistic than they were a few years ago or a year ago at this point in time. So it looks like more declines are in store. Over 5 years, people aren't real optimistic about what's going to happen in the farm real estate market. Again, looking for declines to continue out over the next 5 years. Although, if the 5% turns out, that's really quite modest. But even a 14% or 15% return or decline is still fairly modest in terms of the adjustment that'll be made after the run-up we've had. And as Michael said, we've got this multiple that's big, okay? Mm-hmm. And is that sustainable? And time will tell. There's certainly more forces saying that it ought to come down than there are that it's going to go higher. So time will tell here in that regard.
And so, Craig, for a little clarity, the range in declines you're showing in those first 2 bullet points depend on the quality of land, right? So that range is low quality on the low end of those price declines, and the high quality land likely to suffer the larger price declines?
Well, it's a little hard to say for sure. Now, the conventional wisdom is that high quality land retains its value better than low quality land. But if you look at the data in the report, that's not necessarily supported in all cases. In some cases, that's true. In other cases, it's not. High quality land came down quicker than average or poor. In other cases, it did hold its value better than average and poor. So, I think in general, these things all move together. There's a high correlation between the value of high farmland, average farmland, and poor farmland. So, I guess I don't try to really say by quality of land which one's going to change differently. I think they all kind of pretty much change together.
Okay. All right, a few more things, right? You had the positives we mentioned a few minutes ago.
Yep, yeah, we still have livestock prices that are a positive influence in this market. Interest rates are positive. The net income from the crop sector is certainly a negative influence. And if we look at cash rents, again, the survey shows we're having small declines. There are probably some more declines in store over the next few years. And the thing that kind of jumped out as well on the cash rent side is that the declines have been larger in areas that have seen the biggest increase. Same thing with farmland values. Those areas that increased the most have declined the most now. And so we're trying to find out what direction we ought to be going. But at this point, 2014 was a peak.
Indeed. All right, so let's kind of wrap things up here a little bit. If you want some details, and maybe more detail than what we were able to share today, and maybe you want to ponder this a little more, you've got a report, and Michael, you've got a report as well. They're both on the Center for Commercial Agriculture's website. So if you go to the website, and the home page has a section on it called What's New. Those articles are listed under the What's New section. Just click on them, they'll come up, and if you want to print it for maybe some later viewing, there's an opportunity to print a PDF version of the report as well. So I'd encourage you to do that and maybe look at some of the tables and some of the text. And obviously, I had an opportunity to cover this in a little more detail in the report than what we were able to do today. So that would be one thing to do. The other thing I want to remind people of is we do have another webinar coming up in a few weeks on September 14th. We'll be having a webinar that focuses on the crop outlook, and that'll be just, I think, 1 weekday after the USDA's release of its September crop production and the supply-demand estimates that come out in mid-September. So join us for that webinar. Some of you might have already registered for that. If you did that, you'll get a reminder from us by way of email. But if you haven't registered for that, you could go to our website and just click on the webinars bar on the top of the website in the menu there, and it'll take you to the registration page. And we have a question from a viewer I wanted to tackle. One of our viewers said he was surprised that none of us talked about the impact of the growing global population and hence increasing demand for food over the next 20 to 30 years. A lot of talk about 9 billion people by 2050. We really didn't talk much about that. We kind of, in a way, I suppose, downplayed that a little bit. And he's wondering why that wouldn't support, for example, that price earnings multiplier that we've been talking about. So I'll kick it to Michael first and let Craig respond as well.
Well, one of the things you'll see here is if you look at the 5-year average expected corn price was $4. That's considerably higher than what we saw in the early 2000s. And so it's a combination of perhaps some population increases, particularly in China, some growing demand in China that are supporting that corn price at $4 rather than close to $2 that we were in the early 2000s. So in my mind, that's already bid in to the forecast, the fact that we have relatively higher corn prices at the new equilibrium compared to where we were prior to 2006.
Good point. Craig?
Yes, so here I think Michael and I are going to switch roles. I'm a bit more pessimistic about this growth in income being a driver that's going to create a whole lot of new demand. And I guess I'll try to use history as my reason as to why. That before 2006, when the ethanol demand began to kick in, our advances in technology were more than adequate in generating an increase in supply to satisfy the demand that was in the market. Now, sure, China has created a lot of wealth. Their population wants to eat better. That's increased demand, okay? But our technology engine has been able for a long, long time to keep supply well ahead of demand from the food areas. And I'm optimistic that that's going to continue. Okay, what happened between 2006 and now is that we created a brand new industry in the U.S. that gobbled up 40% of the corn crop. That's a huge, huge increase in demand domestically. And that was a one-time deal. That has now slowed or stopped.
Stabilized.
Yeah. And so now my view of the world is that supply has now caught up with that. And we're back to where we were before that shock came along. And technology is going to keep an adequate increase in supply large enough to satisfy the demand from rising incomes in developing countries. Now, I could be wrong. Okay.
I don't disagree with the supply response, because the supply response has been very strong historically, and I think it's going to remain strong. For example, in the U.S., we've been increasing corn yields at 2% for a long period of time, not just the recent 10 years, but for a long period of time, and that's true in other countries too. We're seeing a lot of countries where they've had very large increases, bigger than 2% increases in corn yields, and so the supply response can be very strong. Particularly if prices remain above $4 in terms of corn.
And I guess
another factor, I still think there's some land in the world that could come into production, and I'll point to Russia and Eastern Europe. I still think there's quite a bit of ground in those areas that if we needed increased corn production, soybean production, we could get it.
And the other factor, I think, is that even with the prices, and I think I kind of agree with Michael, we've already built in some of this growth in demand,
Yeah.
obviously, into the price levels that are being projected, because they are quite a bit
Yeah.
higher than we had in the early 2000s, for example. But what we've seen is an increase in cost. And so even with those higher levels, we're seeing very heavy pressure on margins,
Yeah.
which is going to pressure cash rents and land values. So it's a great question. I
Yeah.
mean, we might be wrong, but that's
Yeah.
our perspective. So thanks to the viewer for bringing that up. We appreciate that question. So with that, I think we're going to wrap up our webinar for today. Thanks for joining us. We appreciate the opportunity to visit with you. You'll have a chance to view this on our website. Probably on Monday, we'll have this posted as a YouTube video, so you're welcome to view that, or maybe share that with a colleague that didn't have a chance to join us today. And we hope you'll have an opportunity to join us for our upcoming webinar. If you haven't checked our webinars page in some detail, I'd encourage you to do that. We do have webinars scheduled all the way out to next spring. So take a look at those titles, and we'll be providing more detail as the winter unfolds with respect to some of the content on those individual webinars. But we do have about one scheduled for just about every month between now and next spring. So with that, on behalf of the Center for Commercial Agriculture and Purdue Extension, I want to thank you for joining us and wish you a good day. Thank you.